All right, we are recording. So a happy Tuesday, November 17th to all. Welcome, welcome, welcome. First off, it's been about a week or two. So actually it's been probably about 2 weeks since we've had our last video session. Actually almost 3. Sorry for the break, but we've all had a bit of a break. Now we come back refreshed here and we're gonna have some fun today. First, normal caveats. Firstly, our forums are private, but our video sessions are public. So please be advised that any and all questions that you are going to ask will be publicly available. And so be aware of that. Also, when I do these particular financial math sessions, I am using a Pro Forma. That Pro Forma will be available for your download in Excel format so that you can manipulate this to your heart's content once done. And what's more, we no longer use shared Pro Formas. Instead, what we use are download links, because we found with the shared Pro Formas, people were altering things, meaning that the spreadsheet became inoperable after time. So now it's a simple Dropbox link. You can download it and you can follow along to this if you're recording after the fact. Okay, without further ado, let's go into this. And let me first start with a little bit of contextualization as to what it is that's going on. So with your permission, I'm just going to load up, hold on please, my Pro Forma. That's not it. It's the wrong Pro Forma. Here we go. There's the right Pro Forma. And let me start screen sharing. There we go. And can someone just please confirm that they can see my screen? I don't have chat functions. Where's chat?
Yeah, we can see it.
Okay, perfect. Okay, guys. So let me first talk about commercial pro formas generally. If you think about it, there are two really different types of commercial pro forma. Whether it is a retail, whether it is a commercial office, it doesn't matter. What you're buying is an income stream, right? And we can figure out largely using the same pro forma what our return is going to be, regardless of whether we're doing a commercial or retail. Like, don't get me wrong, more sophisticated pro formas may have nuances and differences, to be sure. And what we're doing today is a basic pro forma. But on a basic level, really what you're doing when you're acquiring a commercial property is you're trying to acquire the income stream. That's what you're trying to acquire. And that income stream doesn't matter if it's derived from an industrial property or if it's derived from a commercial property or if it's derived from a retail property or whatever. It's all the same. And as a result, this pro forma that we are doing is going to be a basic commercial pro forma where rental income is derived, and that is the purpose of the acquisition. At the same time, if you think about it, there is also a different factor when you are purchasing. Because if you think about it, there are two different ways to purchase a commercial property. One is to take a look at a building and say, I want the rents from that building. And that's really a resale commercial pro forma. The other is a new build commercial pro forma, which basically has you acquiring land, building out the ultimate units, and then renting it out. That is obviously a much more sophisticated pro forma because we have to account for the purchase acquisition, the hold cost of the land, the build out costs of the land, and then how it is that we are going to run the property and the rents that will be derived therefrom. And because that's more sophisticated, I've chosen to leave that section aside for today. We are not going to anticipate, nor are we going to deal with today, buying raw land and developing for the purposes of deriving an income. Rather, we are going to look at this pro forma today. Tomorrow, or the next session, we're going to deal with what happens when we are acquiring land and then building out exactly as I've just said. Today, we're going to look at what happens if I acquire an existing property. What happens if I buy a resale commercial property? And without further ado, similar to the last sessions, I'm just going to explain the basics of what our pro forma today looks like. The first thing you're going to note, I'm finding it very distracting here just because I don't seem to have, just 1 second, please. I don't have, for some reason, I can't see myself, which is, I know, an incredibly vain thing to say, but is also incredibly distracting for me. So just bear with me, please. I'm sorry. I just need to adjust my Zoom before I start. Bear with me, please. I guess I can't. Oh, how interesting. I used to be able to see myself as I went. Okay. All right. Well, I'm going to just have to trust that my hair is still in place, and we'll keep going. So you guys are all looking at my screen, which is a pro forma. And similar to the last time that we dealt with this, you will remember that Excel consists of worksheets, and they have different pages associated with it. Now, the different pages that we have in this instance for the commercial are similar to the last session, a Canadian mortgage calculator. And the reason we are dealing with the Canadian mortgage calculator is because we are assuming, as you would for any investment, that we are using leverage to purchase this property. That is to say, we are using bank funds. The one difference that you will note in this actual calculator from the previous ones that I've done is that I have this line here, total principal paid by the terminal year. You guys can look into the Excel function, which is this, cumprinc C, which basically allows you to calculate the actual cumulative principal that has been paid by a certain year, which in this case will be the year of sale, and in this pro forma is year 5, at the end of year 5. There is a reason that I need to know the total principal paid under this particular spreadsheet, and you will see it as we go. But that is the only difference that exists in this mortgage calculator from our previous residential calculators that we had dealt with. You'll also note that unlike our previous calculators from previous sessions, in this instance, I am not going to calculate the after-tax effect of this investment. Why? Because that is way too complex when you are dealing with commercial properties. The simple fact is that in order to figure out what someone's tax rate is when you are using a holdco that may have various companies, which may have appreciation or depreciation, recapture, or anything else, it is its own spreadsheet into itself. And so what we are going to do, just to keep things simple and conceptually understand things today, is we are going to net at the end of the day a IRR, that is to say the rate of return, the ROI on your investments, and the amount of cash flow that you will get on a per year basis before tax. And it will be incumbent on anyone who uses this spreadsheet to take those bottom line items and add them to their tax amount later on. So is that all clear so far? I'm assuming so. We haven't really touched the math yet. So without further ado, let me go through the last sheet in our Excel spreadsheet, and that is the pro forma itself. The inputs are all in green, and we'll go over what those inputs are in a minute. Those inputs lead directly to the pro forma, and the pro forma will show you year over year what your cash flow is, what your net proceeds are on sale, and what therefore the return on your investment is. So without further ado, and if you do not mind, I'm going to get into the spreadsheet. I'm going to get into the math. It is the case that when you're dealing with pro formas, particularly for commercial properties, you are dealing with the square footage of space. Interestingly, and actually this is something we haven't talked about in the legal forum, but Ty, I know you're on. Maybe we should perhaps consider giving a little talk on it. Calculating square footage of space is something that is in itself fully disputable. And the reason it's disputable is because of the various standards that you use to qualify square footage. This has nothing to do, by the way, with the pro forma. It's just an interesting little tidbit. and that is the BOMA standards, the Building Operations and Maintenance Administration, I think is what it stands for. But BOMA comes in different flavors, 1996, 2008, 2016, and the like. And each of those calculates the square footage of the same space slightly differently. Do you take it to the exterior of the wall? Do you take it to the interior of the wall? Do you count the elevator space? What's the actual gross up? None of this really matters. I'm just mentioning it because someone is going to have a square footage, and that square footage is predicated upon a BOMA standard, if you are wondering. Of course, that is really something that we don't need to delve into right this second. I just wanted to bring it up. What is very clear.
Mark, can I just interrupt? Absolutely. And the distinction as well, when you're doing your leasing, is going to be that your square footage is going to be different on your commercial leases than it is on your pro forma, because obviously you want to charge the tenant for every square inch, including all the bulkheads. No?
That's absolutely correct. And again, I'm very cognizant of the fact that I kind of got off on a tangent there because I'm quite interested in that actually. But as it turns out, I am very hesitant to kind of go into it in any sort of detail right now, just because I'm cognizant that we're doing a math sort of thing here as opposed to anything else. So I'm going to leave it aside for a minute. With buildings, I'm just going to set this up, guys. I'm sorry. I'm just noticing that there's a bit of a problem. So hold on, please. $50 a square foot. There we go. All right. So I'm going to say 20,000 square feet. There we go. All right. So, of course, a commercial unit is predicated upon a price per square foot. And so, as with all of our other spreadsheets, we, in this instance, are going to actually input the square footage and the rent we're getting per square foot. So in this case, I'm going to assume that we have 20,000 square feet in a building. I'm going to assume that we're getting $50 per square foot. So we're looking at, prime industrial space, maybe an Amazon warehouse, something like that. 20,000, by the way, is not a lot of square footage. Just for those people who are joining us and are not familiar with the retail world, the average Walmart proto that most of you visit, that is to say a superstore, is about 218,000 square feet. I think they actually went up to 272,000 and then they shrunk back down to 253,000. But just to give you a sense, that's how much square footage, that's what a 250,000 of square feet look like, is your average Walmart supercenter. So we're talking about a building here that's 20,000 square feet. We're going to assume a rent of $50 a square foot. We're going to assume other income of $10,000 a square because there's a Bristol board or there's a bulletin board for whatever media company it is, or they have a cell tower on the roof or something that generates additional revenue. And we're also going to assume a vacancy rate, which is part and parcel of good commercial planning. So it is the case that whether it is because you're having a transition from one lease to another, or because there is something that remains unleased or whatever it is, vacancy must be planned for as part of a commercial pro forma. And in our instance, I'm going to assume 3% vacancy per year. I'm going to say 5% vacancy per year. Why not? I'm also going to put in how much money I need in order to acquire the property. This, by the way, I'm going through this without any sort of great detail because all of this should be fairly obvious stuff. You guys know that if you're purchasing a property, you're paying money for it. So in this case, you're paying $10 million. You guys know that the cost of sale is probably about 6%. Why 6%? Well, you're going to have to pay your real estate agents 5%, and then you're going to have to pay your lawyer, and you're going to have to pay a whole bunch of other ancillary fees. So let's just call it 6%. The terminal cap rate, I'm going to leave till the end of our discussion. And then you're going to have a sale in year 5, right? So far, pretty simple, straightforward stuff. Oh, actually, nope, I don't want to have that in green because this is a pro forma for a 5-year return every time. So I don't want anyone to change that, please. That's why it's not in green. Okay, so what's our potential rental revenue? Well, that's very simple. Our potential, all we're going to do right now is we're going to figure out what does our first year operational cash flow look like? Well, we're going to take $1 million. How do we get $1 million? Well, we're simply multiplying 20,000 bucks by 50. Every single square footage gets $50 per year. When you say rent per square foot, by the way, you are talking about an annualized square footage amount, not a monthly, right? So the total amount on an annualized basis that you are going to get in revenue is $1 million. But wait, we have a vacancy rate of 5%, and that's 5% of your total revenue. So we're going to have a loss of $50,000. And that brings you to what is termed in commercial world as the effective rental income. That is to say $950,000. We, of course, then add back our other income. Remember, this is our sign or our antenna or God knows what. And that brings us to our gross operating income. Again, many people, particularly not in the commercial world, get mistaken between gross and net. I know it's embarrassing to say that. I know many of us who deal with this would say, what, Mark, are you talking about? Gross is gross, net is net. I know this. But just remember, net is what finally catches you after you go through all the slicing and dicing. Okay? It's a good way of thinking about it. Gross is where you are starting your calculations. So where are we starting it? We are starting it with actual cash flow of $960,000. Why? Because I'm taking $1 million, which I get by taking my square footage and I'm multiplying it by the rent per square. I'm subtracting my vacancy loss. I'm therefore having my effective rental income, to which I'm adding over my other income, and I get my gross operating income. I then have property taxes, insurance, maintenance, management, and other expenses. And what these are is not that relevant. I mean, I've put in the biggest ones with a big other expense line. It could be anything, whatever the expenses are of the property. In fact, when you're doing these pro formas, it's usually when you're on the cusp of actually going ahead and getting all this information on a due diligence basis from the seller. And one of the jobs of the due diligence is to find out exactly what all the expenses are. Because remember, this other expense line may be significant. Does someone have a solar contract? Does someone have outstanding? I could think of about 12 things I've seen just this year alone that don't fall into these particular categories. The solar one was the one that I've just most recently dealt with, and that was actually a plus, but it could often be a negative in a commercial context. But effectively, you have to tally up all of the annualized expenses. And once you do, you have to subtract them from the gross operating expense. And that brings you to the net, what catches you after you've gone through all the slicing and dicing. Meaning that in this instance, we have net operating income of $466,500. I'm going to pause for a minute. Does everyone understand what it is that I have said to date? Does this all make sense so far? It's not, commercial pro formas, by the way, are not difficult. Even though we're dealing with commercial, as long as you approach it step by step, it's actually not difficult stuff. But I want to be sure. Does everyone get this? Okay, Vito says yes. I'm going to assume Vito is speaking for all of you and that you have a collective side chat going on and that you're all in agreement. Okay. So actually, with your permission, I'm sorry. I'm going to make this 40,000 square feet. Why am I going to make it 40,000 square feet? I'm going to make it 40,000 square feet because I just want to have a positive. I want to have a positive pro forma going forward, if you don't mind, just to make this easy for conceptual circumstance. So what that means is 40,000 times 50. So I have $2 million in potential rental income. My net operating income is 1.296, and I have a debt service now that I need to take it off. So the net operating income is what anyone can derive from the property. But the debt service is going to be particular to the individual who owns the property, because obviously everyone will finance this differently. And so we subtract the debt service after the net operating income, because what other people are interested in is not your debt service. What they're interested in is your net operating income, because maybe they're buying all cash. Maybe they have a better interest rate than you. I mean, they probably will have a different interest rate than you. The likelihood is not the same. And so to compare apples and apples and to figure out what it is that should be paid, we remove the individualized debt service line later on for the purposes of valuation. And thus, it is critical that we first derive what the net operating income of a given cash flow is. All right, so The net operating income here is $1,296,000, from which we are going to subtract our debt service. Where does this come from? Well, you'll recall that I told you that we have 3 sheets here. And the third sheet is the Canadian mortgage calculator. And what you will see is that if we have so what I've done here is we've said, all right, our loan interest is 6%, our loan amortization is 25%, and our LTV is 80%. Are you going to get 80% on a actual commercial mortgage? Probably not. You're probably going to get something closer to 70 if you're lucky, 60 if you're unlucky, but I'm going to just keep it at 80% for now. And on that basis, and by the way, is 6% a good rate? 6% is a good rate commercially. It's a commercially reasonable rate. And if you're getting 80% and 6%, then you pretty much have a very good investment, or you're cross-collateralizing it such that the bank is not worried. Generally, in the commercial sphere, if you're getting 6%, you're probably putting down about 65% LTV. If you're putting down 8 to 10%, you may be able to secure something closer to 75 or 80%. I'm using fictitious numbers here just to understand this, and we're going to keep going with this. So let's assume that we are putting down 80%. So you'll see that these inputs are taken directly from these here. And actually, I should change this. It should not, this whole thing, I apologize, should actually be, let me just fix it because I like to put up a proper site. Okay, let me get rid of this. We don't need that. Delete that, because no one should be touching any of this. This is all derived automatically from the stuff that is in green. This should all be in white. There should be no one who touches this at all, to be clear. And so let's deal with this. So we now have $8 million. How do we have $8 million? Because if the purchase price is $10 million and we have an LTV of 80%, then the bank is contributing $8 million. Simple. The interest rate is 6%. Where does the 6% come from? It comes from the input that we had put in right here. The term in months. Well, the term in months is again derived from the stuff here. How long is the term in years? 5. Therefore, 60 is the amount of months. 5 times 12, right? Simple. The amortization is 25. You guys are aware that you can get 30 years. On commercial mortgages, it's harder to get more than 30 years. Sometimes you do see a 35, but let's just assume 25 for the purposes of this. And your compounding periods, because we're dealing with a Canadian mortgage, it's compounded semi-annually. And don't even worry about this last line. I should have just muted that regardless. On the basis of that, I use the PMT function of Excel. And if you are interested in seeing how I do it, you are welcome to download this spreadsheet and play around with it. You will not understand the math behind this if you just take a look at it. You're going to say, what? Why is he dividing by 2 and then adding 1 and putting it to the power of 2 divided by 12? If you're interested in why my calculation for payment or for interest payment or for principal payment or for my cumulative principal payment looks this way and has this equation, you have to go to Google and you have to type in how to calculate Canadian mortgages. Because remember, differentiating Canadian mortgages from American mortgages is the concept that we compound semi-annually. In a very basic sense, what that means is that if I have $100 and I compound, and if I'm earning 5% interest, if I compound that annually, I will get $5 at the end of putting $100 in. But if I compound semi-annually at the 6-month mark, I will get $2.50. And then I will earn 5% on $102.50, which is more than 5%, meaning that the Canadian banks, in saying that they're giving you 2.39% on your mortgage, they are making an effective rate that is slightly higher due to the sleight of hand that is compounding semi-annually. We need to account for that in our spreadsheets, and thus these uber complex sort of formulas where I am ultimately taking the payment function that Excel builds in that assumes you're compounding annually and changing it instead to a compounded semi-annual formula. That's what all that gibberish means. Regardless, what is happening is that on an $8 million mortgage at 6%, I have monthly mortgage payments of $51,184. That's what's going on. And if that's the case, then my annual amount, my annual debt service is simply, hold on a second, G19. Why is that pulling from G19? Just bear with me for 1 second, please. I'm not sure why that is happening. G18. Why is that coming from G18? Oh, it's coming from G18 because G18 is right here, and G18 itself is pulling from the monthly mortgage. So all it's doing is it's saying, thank you very much. I'm going to take 51,184 and I'm going to multiply it by 12, right? Which, why is it just saying G18? I'm not getting this. Oh, G18 is this. I'm sorry. So this is multiplying this by 12. This is being derived from the Canadian mortgage calculator. And this here is ultimately just taking a 614 that is factored here. And what we do then is we figure out what our actual cash flow is before tax. So we have derived our net operating income, then we have serviced our debt. Now we have this cash bucket. That's what's going on. We now have $682,000 sitting in our bank account before tax, but it's in our bank account. Does that make sense, firstly, for everyone? Does that make sense? Okay, everyone gets that. Fantastic. Why in the world does this look therefore different? There is a problem in my math, and I apologize for this. 1 second. 1 second, please. I'm just going to ask for everyone's inputs, potential. Just give me 1 minute, please. Effective rental income. Oh, that's why. Equals potential rental income. Sorry, no, I need the gross. Hold on a second. The gross, I'm sorry. So the gross income, I was correct, is this. Oops, this. Effective rental income, other income, operating expenses, 613,500. I'm just wondering why it looks different. Hold on a second, please. Can anyone see why this is different? This doesn't make sense to me. Hold on a minute. It should be the same for year one. I'm sorry. 1 second, please. 1910. Okay. Vacancy and credit loss. Oh, well, yeah, we shouldn't be doing the vacancy and credit loss. Hold on a minute. Let me just see something. I think I figured out what the error was. Sorry, guys. I just built this before this session, and 1296. 12, yeah, that's it. Okay, so what it is it's not gross potential income. It's the rental income. Rental income. There we go. Okay, sorry about that, guys. Okay, so our normal rental income is 2 million. Now it is replicating what we have on the previous page. Sorry, that was my mistake. And the vacancy and credit loss, is that still 100,000? Yes, it is. Okay, so what you're seeing here in this column is pretty much exactly what we had here, right? Where we have the cash flow before tax of 682,285, and we should have that here, 682,285. And so if you think about it, what we were doing here was we were deriving our first year operating statement. And here, it's really a first year operating statement. That's what's going on right here in this year one. But of course, we have year 2, year 3, year 4, year 5 to deal with. Now, when we are doing out these types of pro formas, we can go ahead and actually insert new numbers for year 2, year 3, year 4, and so on and so forth. But the likelihood is you won't know all those inputs. And so doing your estimations is a perfectly acceptable way of building out a commercial pro forma. And my estimations are contained here in this box. What is the increase that is going to take place in year 2, year 3, year 4, year 5, and year 6? What is the increase that's going to take place for the other income in these years? And what is the increase that is going to take place in the operating expenses? And you can change these and make them variable as you like. But to my mind, I have gone ahead and made them all 2% just to make it easy. And what that means is that year 2 has rental income, which takes this number and multiplies it by, well, we take our rental income and we see that it's gone up 2%. So we are upgrading our 2 million to $2,040,000 because in year 2, there was a 2% increase. And in year 3, there's a 2% increase on the 2,000,040, and so on and so forth, and so on and so forth, allowing us to project what our cash flows before tax are going to be every single year. This brings us to the crux of what it is we're dealing with. So now we know that if we invest $10 million or $2 million with the bank lending $8 million, but if we buy this property for $10 million, we will have cash flow before tax in year 1 of 682, 708, 734, 761, and so on and so forth. And you can do a return on investment if you like on an annualized basis, but everyone can already figure that part out, and I didn't put that into the pro forma. Instead, I concentrated on what happens when you sell so that we can figure out the totality of the investment. And in the terminal year, you will see a different input on this front screen. That terminal year has what's called a terminal cap rate. I'm going to pause and I'm going to explain what the terminal cap rate is, because it is critical to understanding what the actual return on your investment is. We have dealt with cap rates before in our forum. In fact, it was one of my first write-ups on cap rates, and I would encourage you guys to take a look at it to be sure. Sorry, every time I see a mathematical thing that is problematic, I have to fix it. It's a thing with me. I'm sorry. There we go. The cap rate is how we determine the value of a property and is property dependent. So I've gone through this in the previous sessions, but I'm just going to talk about it again. Effectively, what we are buying here is an income stream, and income streams are not all the same. An income stream that if Walmart promises to pay you $100,000 and if Pier 1 promises to pay you $100,000, and it's the same retail, right? It's a retail shop. But if both of them sign a contract and say, we will pay you this for 20 years, would you pay the same amount for both income streams, even though it's for the same amount of money? You would not. You would pay more for the Walmart one. Why? Because there's a greater chance that it will continue into the future because of its financial viability. As a result, you're ready to pay more for that income stream, even though it derives the exact same amount of money as a Pier 1 income stream. And if we think about asset classes themselves can be demarcated into those things where the income stream is likely to continue, multi-res. When times go bad, when we have COVID, people still need a place to live. These giant apartment buildings with 100 units in it are going to always be the most valuable asset class because people will never stop paying for them. Versus hotel, which is the first thing that people cut back on. And as a result, if I can make $60,000 from a hotel or $60,000 from a multi-res apartment building going forward, no matter how nice the hotel looks, I want that multi-res income stream. I will pay more for it. It is more valued, and thus the cap rate is lower. The terminal cap rate is going to be the one area of art that you require in order to do the pro forma, because what you are trying to do is you're trying to say, in X number of years, in this case, on this pro forma, in 5 years, what will be the value that people will pay, that people will ascribe to the income stream? The cap rate is determined by simply taking the net operating income, not with the debt service ratio factored in. I've talked about this because everyone has a different one, but rather just taking the net operating income and dividing it by that cap rate. The lower the cap rate, the more people are ready to pay. That's the way the math works. Generally, hotels are presently around 9 to 10% in the market space. Multi-res is about in Toronto. It's very, very context dependent on what area you're in. In Toronto, multi-res is at about 2%. In this instance, I'm going to assume that what we're dealing with is some sort of B-class industrial park. I've put in a terminal cap rate of 7.7%. How we derive that, I don't know. But you will have to figure out what a reasonable cap rate is. And an easy way of figuring that out in terminal year is to say, well, what is it today? Okay, it's 5% today. That will be a known factor. You can look up the Ernst & Young reports and a whole bunch of others. KPMG does an annual cap rate report that will give you a good sense of where things are just on a base level in a given city for a given asset class. Okay, well, if it's X today, do I think the economy is going to get better or worse? Do I think interest rates are going to go up or down? And you'll amend it slightly. In this instance, we've derived this magic figure, 7.7%. Okay, 7.7% means that if we take in the terminal year, that is to say after year 5, or in this case, year 6. Sorry, I'm thinking a lot about Trump's lawyers who went and claimed there was a non-zero number of lawyers in the courtroom. So I now use words like that when I'm speaking. If in our non-year 5, in our post-year 5, thus year 6 analysis, we are assuming that our income stream will be 7.7 capped. What does that mean? That means that in our terminal year, because we've gone up, our net income has gone up by the variability factors that we've put in here, right? 2% per year. Because it's gone up and it has reached in the terminal year a net operating income of 1.431440, we can simply take this amount and divide it by the terminal cap rate. And we find that the property that we had purchased for $10 million 5 years ago is now selling for $18,590,000 today in year 6. From that, of course, I have to subtract the cost of sale. Where do I get that? Well, I take my 18,590,000 and I multiply it by my cost of sale, which is here in this case 6%. And then I minus the loan balance. How much money is still payable? Now, the loan balance comes from my mortgage calculator. And if I take a look, I'm able to figure out the total principal that has been paid to date, right? That's my cumulative mortgage. And then if I simply take my original loan of 8 million and I subtract the principal that has been paid to date through that complicated equation that I showed you, which you will have access to, which you can explore, I know what my loan balance is going to be. And so how much money do I end up with? Well, I take this, I subtract this, and that gives me a net sale proceeds of $10 million. How much money did I put into the deal in the first place? I put $2 million in. So my investment was 2 million. I'm netting 10 million. And thus my total pre-tax return on investment is 514% over 6 years. And my annualized tax rate, pre-tax ROI, is about 102% every single year. Now, these investments are very hard to find. These would be a very good investment. Everyone would be going in on an investment for $10 million where fundamentally they're able to generate $2 million per year. And that's the reason this looks as good as it does. But I just want it very clear as to what it is we're doing and how we're doing it. This is a very limited basic commercial pro forma, but is the basics upon which you can construct something more complex. And indeed, how you build on it is something I am going to talk to each of you about as we move forward. Oh, hold on. Where is, sorry, just 1 second, please. Huh. Is everyone there? Yeah, it seems everyone's there. Oh, there we go. As we move forward. So once we are prepared to do our next commercial pro forma, what we will be doing at that point is we will be actively going forward and constructing a pro forma that involves the purchase of land before we get to this pro forma, this basic pro forma. Because after we've acquired land and after we figured out how to account for construction payments, well, then we can just fit this pro forma in the moment it starts becoming revenue generating. And so you can see how this becomes the building block of so many other commercial pro formas going forward. And that is, I think, where I want to end things today. We're at 10:40, so I'll give 5-10 minutes for questions. I try not to make this too math heavy, and I try not to make this too complex. There is a lot in my normal commercial pro forma that actually is much more advanced than this. But this is the basics, which is the whole purpose of our group and is what we're trying to learn together. So please, I'm going to open it up. Any questions you have, always available. Any questions for me? No. Okay, well then, that was a good one. So guys, look, thank you for attending this. As I said, just as a final note, this stuff is critical, This is more important than law. This is what, don't get me wrong, law is very important. This is more important than anything because you only go to a lawyer and you only have the ability to ultimately argue these things before a lawyer if the business case makes sense. And for you guys as realtors to actually go ahead and promote a project, you need to be able to say to your client, this makes sense and here's why. And if it doesn't make sense, there's not going to be any law to argue about. And if it does make sense, you'll be able to afford your lawyers. So I would strongly encourage you guys, more than our other forum is very important. It teaches you how to be a good realtor. This forum teaches you everything you need to know to be an excellent one, to be one that will excel based on math, which is really what it is that your clients are expecting of you, in addition to the basic competence and legal understanding that comes from the other forum. I do hope that you will encourage your friends, your family, and anyone you like to join this particular forum. There's no restriction on entry. I do think people benefit. Jack, as regards to your question, this video will be online in about an hour or two. And when I make the video available, I also make the download link for this pro forma. So you guys can all download this and start constructing this to your heart's content. Any other questions, guys, before we call it for the day? Okay, well, I wish you all the very best. And thank you again for being a vibrant part of our group. Let's continue to rock this one as we rock our other forum. Let's grow this and let's all learn together. Thank you again for everyone coming today.